Hi everyone. This is Brian here. Um, just give me a minute. Can you hear me clearly? My Maybank Vietnam colleagues.
Yes, we can.
Okay, that's great. Okay. Okay, so I'll kick off with macro presentation. So this is to give an update of the Vietnam economy at the latest juncture, which is based on the May 2022 data. So just a recap that the first quarter real GDP expanded 5% from a year ago, which was a very robust recovery and just a slight moderation from the fourth quarter of 2021 outturn of 5.2%. This was led by the manufacturing sector. However, lately, trade has moderated while consumer sectors have flourished. I'll go further into this in the next slides. So industrial production continued to recover, increasing 10.4% year on year, while increasing a very healthy 4% from the previous month of April. 5-month 2022 industrial production on average has increased 8.3%, which is very resilient and robust showing for the Vietnam economy. This was led by manufacturing production, which rose 9.2% year on year over the 5 months of 2022. In May itself, manufacturing production led with a gain of 12.1%, which was an acceleration from 11.7% in April. This was actually driven by wearing apparel, garment production, which expanded 27% year on year in May, which was much quicker than the 22% recorded in April. Now, it's surprising that garment production held up in spite of anecdotal reports that the garment industry was facing production difficulties due to logistical bottlenecks caused by China lockdowns. The Vietnam Textile and Apparel Association said that many of its members are facing difficulties to meet orders due to shortages of China materials. However, adaptation measures which have been tried to be adopted by factories, such as running down existing materials inventory, prioritizing orders with sufficient materials to produce first, as well as substitution with Korean and Thai materials, could have helped reduce the disruption on production. Computers, electronics, and optical products fell 5% month on month, which was its second consecutive month of decline. For instance, mobile phone output was about 2% lower than in April, while phone accessories dropped 6.6%. Now, these segments' performance likely reflect the impact of supply chain disruptions from China lockdowns. If you look at the chart on the right, the strong performance of industrial production was actually mirrored in the strong performance of the PMI for manufacturing, which actually rebounded to 54.7 after 2 months flat at around 51. This latest 54.7 performance is actually the highest since April 2021, if you look at the dotted line, the horizontal dotted line. So what was driving this PMI reading? That would be strong performance in output as well as strong performance in employment, as factories managed to ramp up output as in conjunction with the reopening, and also factories managed to attract managed to get more workers back onto the factory floors. However, the PMI survey also offers valuable on the ground information that China lockdowns actually limited export demand and caused further delivery delays. The supplier delivery times had lengthened sharply to a greater extent than in April. The firms also reported that they were drawing down on stocks inventories to help meet order requirements, which would have helped to cushion the impact of, I guess, import disruptions from China from on industrial production. So as I mentioned in the previous slide, so Vietnam is highly dependent on China for imports. It imports 32.2% of its total imports from China. That's China's its largest import source. If you look into the breakdown, the electronics segment and telephones depend on China for around between 30 to 40% of their imports, which I guess gives a suggestion as to why production actually dropped month on month in May. And for fabrics, actually it's even higher, which I guess tallies with the anecdotal reports from textile firms that they were facing material shortages. Fabrics and textile actually import the industries of fabrics and textile, leather and footwear, etc., would import around 50% or so of their imported materials from China. So likely impact from China's lockdowns was also seen in slowing merchandise exports. Growth in nominal goods exports slowed to 18% from 25% in April, while declining 7.2% over the previous month. Since this was nominal data, export volume likely declined more, given that the nominal outturn would have been flattered by rising prices. So nonetheless, over the first 5 months of 2022, nominal exports were up 16.3 year-on-year, which is a rather good showing. Exports softened in May on the back of telephones and components, textiles and garments, as well as footwear. This would reflect the supply chain disruptions coming from China. Imports growth slowed less than exports, increasing 0.5. On year-on-year basis, it slowed to 14% from 16% in April, but on a month-on-month basis, it actually increased slightly, 0.5%. And this was probably because the supply disruptions from China were offset by surging prices of commodity imports. Over the first 5 months of 2022, imports were up 15% year-on-year. The trade balance in May fell to a deficit of $1.7 billion after 2 consecutive months of surplus. Nonetheless, the year-to-date trade surplus remains at a surplus of around 500 million. And we actually, the reason for the bad performance over the past 2 months was because of China lockdowns. And on the whole, we still do expect a small trade surplus for the year. So there's also another data point that container throughput of all Vietnam seaports inched down 1% year-on-year in May 2022 versus 2% growth in the first 4 months of 2022 because of China's lockdown. So if you look at the country breakdown of exports, you can see that exports were actually flattered by robust demand from most major markets. However, you can see from the green line that exports to China slowed from around 20% year-on-year in April to just 3% year-on-year in May, whereas the rest of the lines indicating exports to other major markets are holding up. So basically, the channels of disruptions would have been that factory closures in China, especially in Shanghai, as well as port congestion and strained capacity at seaports would have actually impeded for one, demand for intermediate components supplied by Vietnam from China's factories, and also constrain the flow of Vietnam's goods to China, which is why exports to China had been slowing. If we move on to the consumer sector, tourism demand in May was boosted by the relaxation of international border rules. For instance, the COVID test is no longer required. I think that was eased sometime in mid-May, and also you do not need to be vaccinated to travel to Vietnam. Basically, the international border rules have been relaxed more or less completely. That resulted in a 70.6% increase month on month in international arrivals. And also the SEA Games, which was held in Hanoi in May, also probably helped attract some tourists. However, international visitor arrivals remain at only 9% of pre-COVID levels. This is more or less around the same as the rest of ASEAN, other than Singapore, which is in slightly higher at about 15%. So far, in the first 5 months of 2022, there were only 365,000 international visitors. The government's target this year is 5 million international visitors. Given the performance over the first 5 months, and crucially, the absence of China tourists, which make up around a third of international tourists pre-pandemic, it's unlikely that the government's target of 5 million this year would be met, even as, of course, we expect that international tourists will continue to steadily return to experience Vietnam in the coming months ahead. However, domestic visitors have helped to cushion the impact on the tourism sector. So you can see that domestic visitors already exceeded pre-COVID levels, as indicated by the gray color line in the left-hand side chart. This strong demand is coming from reopening and I guess appetite for travel among Vietnamese. However, that said, the spending of the domestic visitors remains only around a tenth of international visitors, as indicated by a McKinsey survey which was conducted in 2019. So while there is strong demand from domestic visitors, it would probably not help to fully offset the revenue gains from international visitors. So I guess on the right-hand side chart is just to show you the country breakdown, that so far it's US and ASEAN that has been leading the demand from international visitors, while you can see that China visitors, which is the gray line, is basically almost at near zero. So consumer-facing sectors will update on the reopening and return of tourists. There was a marked acceleration in nominal retail sales to 22.6% year-on-year versus just 12% in April. Retail sales increased 4.2% over the previous month to a record high. You can see from the chart on the right that nominal retail sales has already recovered to the peak, the previous pre-COVID peak of January 2020 in April. And right now it remains in May, it already exceeded the Jan 2020 levels by almost 6%. Over the first 5 months of 2022, retail sales have risen very robust 10% year-on-year in nominal terms and 6.3% in real terms. The jump in May retail sales, if you look at the breakdown on the left-hand side chart, was of course led by tourism demand as well as accommodation and food, since the country continues to reopen and footfall at restaurants and shopping centers continues to increase. So realized FDI was up 7.8% year-on-year in the first 5 months of 2022. As you can see on the left-hand side chart, on the reopening of the economy, as investors are able to enter Vietnam as the international border curbs are eased, and also as construction projects are able to, I guess, pick up pace a little bit. New registrations, a newly registered capital, which indicates, I guess, commitments to invest in the country, is however down, has declined. So in terms of the numbers, it's 5.7% in terms of the number of projects, slight decline, but 53.4% in value terms. However, the manufacturing sector continues to remain a bright spot. Injections of existing investors rose. On the other hand, adjusted registered capital actually rose 50% year-on-year. So new registrations have been declining, probably due to lower investor appetite on global headwinds, whereas the fact that existing investors' injections continue to increase shows that investors remain confident in the country. I guess the difference between existing and new investors would be the sense of familiarity that would, I guess, give you more confidence to an understanding of the country to invest even in the midst of emerging global headwinds. So if we move on to inflation, headline and core inflation both rose further in May. Headline inflation accelerated to 2.9% in May from 2.6% in April, whereas core inflation inched up to 1.6% from 1.5% in April. Over the first 5 months of 2022, inflation is still contained. Headline is at 2.2%, while core is at 1.1%. Now, this is much better than the rest of ASEAN, actually. So the reasons for which I will explain later on in the presentation. Inflation has mainly been led by transport. So transport rose 18.4% in May, which is a step up from 16.6% in April. Transportation costs have increased mainly because of the hike in petrol and diesel prices, repeated hikes actually, as well as public transport fares in line with the rise in global oil prices. Services prices continue to edge up as demand recovers. Dining out inflation has increased to 3.9%, which is just slightly more than 3.8% in April, or 0.4% month on month, as eateries passed on higher fuel and ingredient costs amid higher consumer demand. Culture, sport, and entertainment inflation, which is another, I guess, tourism-sensitive component of the CPI basket, jumped to 2.8% from 1.8% in April due to increasing tour package prices and hotel rates as tourists return. However, if we look at the right-hand side chart, it will show you that, so basically the bubbles indicate the weight of the size of the bubbles would indicate the weight of inside the CPI basket. So you can see that food and food stuff, which is, I guess, the largest weight in the CPI basket at 33.6%, rose a benign 1.3% year on year versus 1.1% in April. So we saw an increase in fats and oils costs slightly on the surge in palm oil prices on the Indo-export ban. Rising transportation and animal feed costs also led to an increase in poultry meat and egg prices by around 1% month on month. Noodle and bread prices also increased around 0.6 to 0.8% month on month, and that's primarily because of higher wheat prices following India's export ban. So you can see that the global trends, I guess, wheat, oils, as well as animal feed, that is feeding through to contribute to increasing food inflation in Vietnam. However, food inflation has remained contained. Why? Because rice prices are benign due to abundant domestic supply, though fertilizer costs have risen. Vietnam is actually the world's third largest exporter of rice. Pork is another crucial component that has been keeping inflation in check. It accounts for more than 70% of Vietnam's meat consumption, and prices are flat. And in fact, yes, declined. It's still lower compared to last year because of the swine flu outbreak last year. And right now, there's a lot more abundant domestic supply as compared to last year's shortages. Vietnam is actually the 6th largest pork producer globally. Also, vegetable prices actually declined month on month by 0.4% due to favorable weather and an abundant harvest. So you can see that basically in some, the pork, vegetables, and rice prices, which account for, I guess, quite a large percent of food consumption in Vietnam, remain very, very contained, and which has actually helped keep Vietnam's food costs contained compared to the other ASEAN countries. So if we move on to the outlook going forward, we think that border reopening and easing of domestic public health measures will boost inbound tourism and domestic demand. You can see from the chart that this is a stringency index, which actually captures how strict COVID-19 restrictions by the government are in each ASEAN country. You can see that Vietnam has steadily declined in the past few months to become the lowest in ASEAN. And indeed, the government has been very, very quickly easing domestic and as well as border restrictions. And this should actually benefit consumer-facing sectors like retail, accommodation and food services, and arts, entertainment, and recreation. In addition, government stimulus measures under the $15 billion USD economic recovery package passed in January, such as the 2 percentage point VAT cut on most goods and services, and as well as the interest rate subsidy on bank loans will also support Vietnam's economic recovery. In addition, reopening and supply chain diversification from China will boost FDI inflows, particularly in the manufacturing sector, and that should provide some support to growth this year too. However, on the trade side, as we already saw some initial softening in May, emerging global headwinds are likely to dampen the reopening tailwind and undercut growth in trade-related sectors like manufacturing and wholesale trade. Prospects for Vietnam's top three export markets, which is the US, China, as well as the Eurozone, which collectively account for nearly 60% of total exports, have dimmed. So if you look at the charts over here showing the impact from a China slowdown, China's economy is struggling amid, I guess, rolling lockdown since March to contain the Omicron outbreaks. Factory closures and transport bottlenecks have disrupted Vietnam's exports to China. The recovery of China's domestic demand is likely to be hindered by the government's cautious approach towards easing of COVID-19 restrictions amid its unchanging zero-COVID stance, as well as the risk of reimposing restrictions, as we already saw some indications in Shanghai over the weekend. We have some estimates that I guess China's slowdown, every 1 percentage point decline in China's growth could actually shave off around 0.6 percentage point of Vietnam's growth, because Vietnam is actually the second most trade open economy in ASEAN, just behind Singapore. Trade is at 200% of GDP. So when there are global headwinds, there's no way that Vietnam will be unaffected. If we move on to the Eurozone economy is expected to slow due to commodity price pressures, as well as severe supply chain bottlenecks stemming from the Russia-Ukraine war. The recent Russian oil ban by the EU is likely to put on further pressure because the EU depends on Russia for around 30% of imported oil. EU accounts for a sizable 12% of Vietnam's exports. It's Vietnam's third largest export market. And if we look at the chart on the right, there's another measure that basically accounts for measures the percentage of Vietnam's nominal GDP exposed to final demand like consumption in the EU. That accounts for direct exports to the EU as well as indirect exports, which means like Vietnam would export to another country and the other country would export to the EU and so on. So that this metric captures that. And you can see that Vietnam has 5.4% of nominal GDP exposed to EU final demand. Key message here is that it's actually also the third highest in ASEAN, behind Singapore and Cambodia. So if we move on to the US, aggressive US Fed tightening may spark capital outflows. So aggressive monetary policy tightening is expected to moderate US growth, although the robust labor market and high savings buffers built up during the pandemic will likely provide some support to consumption. But US is Vietnam's largest export market, comprising 30% of Vietnam's exports. And if the recently more and more trading houses have been calling for a significant US slowdown because they opine that the Fed will not be able to achieve a soft landing. Slowdown in US growth would impact Vietnam's growth the most, even more than China and even more than China and EU, since the US is the top export market and the world's top consumer market. I mean, in addition to direct impact on Vietnam, decline in US growth would affect other economies as well, which would in turn spill over to Vietnam. In addition, there's the capital outflow channel. So a more aggressive pace of US rate hikes risk sparking capital outflows and pressure on the Vietnam dong, and risk inducing disorderly market adjustments that would pose possibly a threat to financial stability in a worst case scenario. But markets expect the Fed to tighten to 3% by end 2022 and reach a terminal rate of 3.3% by mid 2023. Right now, the Fed funds rate is only at 1%, so it's quite an aggressive pace of tightening that markets expect. However, we think that the risk of destabilizing outflows is, I guess, mitigated to a significant extent by Vietnam's robust external buffers, including a healthy and stable current account position, robust medium-term investor confidence in the economy, as well as ample foreign reserves of around $110 billion to I guess defend the currency if it's necessary. It's worth noting that foreign reserves have more than tripled from 5 years ago. So Vietnam is in a relatively safe position. If we move on to the outlook for consumer price inflation, so as I said, consumer price inflation has remained better contained than the rest of ASEAN due to successful government price control measures, the consumption of the food basket, as well as the nascent demand recovery, since it just went through a very, very bad lockdown last year where GDP declined 6% year on year. If we look ahead, demand pressures from reopening and returning of tourists is likely to boost services inflation. Supply side cost pressures are likely to remain elevated, stemming from high commodity prices as well as rising food protectionism. We have a lot of more and more countries starting to come out with export restrictions for food, like India restricted sugar exports, India restricted wheat exports, Malaysia restricted chicken exports, and Indonesia had a palm oil export ban for about a month or so. So that wave of rising food protectionism is probably going to increase Vietnam's food inflation going forward. Although the extent to which would again be mitigated by the abundant domestic supply of crops and livestock due to Vietnam's status as a significant agricultural producer. And also it would be likely to be mitigated by government efforts to rein in the price hikes of essential products. So I just want to point you to the table on the right. You can see that Vietnam is a net food exporter. It is a significant producer of fishery products, rice, etc., vegetables as well. So on balance, we expect headline inflation to increase significantly from last year, which last year was 1.8%. This year, we expect it to be 3.7%. And next year, as I guess the demand continues to recover, we expect headline inflation to increase further to 3.9%. On monetary policy, we expect the SBV to commence monetary policy normalization in the fourth quarter of 2022 with a 50 basis point hike to policy rate on broadening inflationary pressures towards the end of the year as consumer demand gains traction. We think that SBV will be patient on tightening, even as other ASEAN central banks have already begun their tightening cycles. We have Malaysia and Philippines that, for instance, already begun their rate hikes. The SPV, we think, is likely to prioritize growth at the current juncture in view of the emerging global headwinds to the Vietnamese economy, and also given that inflation remains relatively contained, it hasn't even reached 3% yet. And lastly, that the risk of a large and disorderly Vietnam dong depreciation from Fed tightening are relatively mitigated due to robust external buffers, which would, I guess, reduce the need to hike rates in order to close the rate differential with the US. All in, this is my final slide. So as a recap, basically, I'm expecting the 2022 GDP forecast to be at 5.8%. It's still one of the fastest in ASEAN, but below the 6% to 6.5% target range, which was actually set by the Vietnam government. And this is because I feel that although there would be tailwinds from reopening, it would be offset by slowing global growth, which are likely to dampen Vietnam's economy from the trade side. On inflation, as I said, inflation will be forecasted to be 3.7% this year, and the SBV is projected to tighten in the fourth quarter of 2022. So yeah, I will stop here and I will let Huy take you through the market outlook. Thank you.
Morning.
Sorry, Vietnam team. I think the rest of you will have to mute your microphones and silence your laptops as well, so that we won't have an echo.
Yes. Morning. So to save your time, we just need a couple of minutes to present my view, our view about the market in the second half. Okay. Okay, so we believe that the current correction is just a short-term setback of the stock market, and we still believe in the long-term uptrend. Just a quick review about the market in the first half this year. The VN Index dropped about 14% year to date, but most of the loss occurred in April and May. So the excess speculation fueled the market rally in late last year, and the crackdown on such activities sent the market down in April in past 2 months. Breaking down by segment, sectors, most of the sectors suffer loss, but a few still post some gain, and some emerge as the strong performers. They are chemical and energy, which are enjoying the rally of the global crude oil, and logistics, retailing, and banks, which are the main beneficiaries of the country reopening. But on the flip side, property-related sectors like construction, material, and real estate, were the worst performers because of the ongoing legal turmoil. In terms of liquidity, daily trading value dropped about 40% in May to around $600 million per day. But we observed to healthy development in terms of liquidity proportion of large cap and blue chips is bottoming out in our view, increasing from around 30% to 40%, and we expect this will continue to increase to 60% going forward, which is sustainable for upcoming rally of the market. And second, we see that institutional investors are becoming more active. Their share of trading value increased from 10% early this year to around 20%, and there's still it may continue to grow to 30%, which is the level of pre-pandemic level. And foreign investor net pot for the second month in a row, and this is first time since 2019. So we believe that these development are healthy and make the upcoming rally of the market more sustainable. Back to the economy, as Brian has presented, we look at retail sales, which set a new record in May. PMI a 4-year high also in May, and credit growth 8% year to date, with twice the base of the same period last year. And we believe that this data is enough to show that the economy has returned to a high growth trajectory. From the market perspective, there are still two major concerns. The first one is the impact of the legal turmoil. I don't go into detail again, but to put it simply, we compare the current one, turmoil, with the previous one 10 years ago, and we believe that the previous one is has a much larger scope, and it hit directly to the banking system. But what we see is the economy then still grew 5.2% and accelerated to 5.4% in 2013. So we believe the current correction is just and back to the stock market 10 years ago. After some early correction, the market had all the loss in 2012 and continued to grow further in 2013. So we expect similar development this time, and the correction in the past 2 years is the early loss, and we expect the market will steadily recover going forward by the end of this year. The second concern is inflation. But again, as Brian has presented, we see that inflation is transforming from a cost push to demand pull. But again, we believe that inflation will remain benign in going forward. And more importantly, despite these two concerns, the S&P global rating just upgraded Vietnam to PP plus, which we believe affirm the achievement of Vietnam economy in two pandemic year and the recovery post pandemic. So we believe that the legal turmoil and rising inflation is just are just a few speed bumps of the economy growth. For the stock market, we maintain growth forecast of 2022 corporate earnings at 25%, but we lower the target PE to around 14.5 times compared with the previous 16.5 times to reflect softer earnings in the second half of this year. But again, in the longer term, we continue to have a bullish view on the market thanks to the strong economic growth, the potential upgrade of country credit rating and equity market in the medium term. For going forward, I mean, in the second half of this year, reopening will continue to be the main theme, like in the first half. So we bullish on retail, logistics, and banks, and that's why our stock pick mostly focus on these sectors. We have NWG, income retail for retailing. We have ACV, ZMDF for logistics, and we have Vietcombank, BB Bank, and Techcombank for banks. We also pick gas as our top 10 pick because it directly benefit from the current high crude price, and moreover we also pick Hafat, HPG, and Vinhome. Despite of their industry specific headwinds, we think the valuation are extremely cheap, given their number one position in respective the industries and healthy financial metrics. So this is all for our my presentation about the market in the second half this year. Thank you. Thanks for your attention. So now we move to Q&A question.
Thank you very much. The floor is now open for questions. Participants can either click the raise hand button to join the queue, or you can key them into the chat box at any time. So anyone for the first question, please?
Hello. Hey, sorry. Hello.
Yes, we can hear you. Yeah.
Right. So I may have a question to Brian. Like, okay, in your presentation, you forecast the GDP of Vietnam at 5.8%. So has that factored in the slowdown in US, EU, and China?
Yes.
Because compared to other house, I know that we are the most conservative in the GDP forecast. For the inflation, the 3.7%, I think is a bit now kind of bullish forecast now. Do you see there's any risk that we can, stray away from that? We can go up to higher level of inflation.
Yeah. Okay. Yeah. So to your first question, yes. For GDP growth, I factored in the. I've already factored in some slowdown from the US, China, as well as the EU into the forecast, which is why my forecast is actually below the target range set by the government. I think if there weren't these headwinds, and if everything was going fine on the external demand side, and the reopening of the Vietnam economy, and also government stimulus support would actually easily get Vietnam's GDP to I guess upper half of 6 to 7, 6.5, between 6.5 to 7%, if not for these headwinds. On inflation side, yeah, so I guess recently there has been more concern about inflation, I guess in the stock market in Vietnam and also from other houses. But at the moment, I think that given the trajectory of inflation so far in 2022, I think that the risk to my forecast at the moment, I think the most likely scenario would actually be for inflation to fall within the target range of SBV. The target range is 4% annual average. So far, given that in the first 5 months of 2022, headline inflation has only been 2.2%. I'm expecting the full year average over the 12 months of 2022 to be 3.7%. That actually already factors in a significant pickup in inflation over the coming months, and that's to account for, I guess, commodity price pressures as well as the demand reopening. And I guess on top of that, even though the SBV hasn't actually hiked its benchmark rates, however, on credit growth, there actually have been reports that banks have already, I guess, hit their credit cap for the year in the first few months, and the SBV seems to be cautious in, I guess, increasing their cap or like granting them more leeway to dish out credit to the private sector. So the SBV is trying to be cautious in controlling inflation. So it is vigilant in that aspect. There's already some so-called implicit action from the SBV on that front, and on top of that, given that the track record of the government in controlling the inflation so far, even as other countries have, inflation has risen by much more than Vietnam, I think overall the forecast of 3.7% is reasonable. Yeah.
Yeah. So for that forecast, on what level of oil price that you base on, like what is the average oil price?
Yeah, sure. So the average oil price that Maybank is currently Maybank's currently estimating for 2022 is $100 as of this moment. Yeah.
So there's a upside risk here.
Yes, sure. There's upside risk. I guess if China manages to ramp up its recovery, especially, which will actually increase the demand for oil since China's the largest consumer. But my personal view is that it's still far from certain that China is going to be able to ramp up and reopen, given its very, very cautious stance for zero COVID. You can see that there has been in and out lockdowns. I mean, Shanghai they just locked down a couple of districts, and even in Beijing, virus cases are flaring up. Yeah, so it's not super clear for me that oil prices would actually shoot up into such that they can average $130 per year or something like that. Yeah, yeah.
Thanks, Brian. Yeah, I got that. Actually, for GDP growth, we are not so much concerned for now because we still have room to push it up because the public investment is still behind the schedule and they are going to accelerate that.
Yes.
From the textile, from seafood exporters that we talked to, they already have orders through the third quarter, so it's still okay.
Mm-hmm.
So and take into account Brian's estimation of GDP growth for this year, taking into the slowdown, we still have about 5.8% growth. Actually, other houses have over that. So I think on the growth side, we are not concerned. But now the market, especially the equity markets, are concerned about the inflation. So I think we should look into this more. So although you are conservative with the GDP, I think we are a bit generous with the CPI, the inflation. I mean, I think people may want to ask more the question about the inflation, but for now, we think we are in the good shape in terms of food price, which account for 35% of our CPI basket, but the gasoline price, which is something that we still need to watch. And we are building the scenario for this. I think now we need to accept the inflation in the range of 4 to 4.5%, and that could be okay. And you just mentioned about the credit growth, and I think with the inflation rate of around 4 to 4.5%, it will not change the central bank's the credit growth target. I think 14% credit growth target for Vietnam is still okay. And in Vietnam, the way that we execute the monetary policy is different from other market. We cap the credit growth. So whatever the interest rate we have below, I mean, it doesn't, actually, if you lower the interest rate, it even support the inflation because, unlike in the market, you lower the interest rate, that means you bump more money into the market through credit growth. But here in Vietnam, we cap it already. So I think lower interest rate for Vietnam would be helpful in terms of control the inflation. So that's my view. I still think that the inflation, there's some upside risk here, but the question for us, we need to understand what kind of inflation has a market factoring. So I just want to roll out this as a question and food for thought for our audience as well. Thank you. I think we have some questions here.
Thank you. Yep, in the chat box, we have this question. What is profitability of US recession in your view? What is your expectation of oil price should that happen? If then, is gas a safe choice?
I think there are two parts of the question. So for the one on US recession and oil price, let Brian handle it. And then for gas, I think our analyst Trian would answer it later. Thank you. Okay.
Yeah. So I'll provide a qualitative view of the US recession. I guess my view of the US. So I guess currently right now, Maybank, we are not actually factoring in a US recession in the sense that our forecast for US growth is positive for 2022 and 2023, hovering around 3% or so. But definitely we do expect there to be to be some slowing. It's very tough for, I guess, to be some slowing and for the lending to not completely be a soft one, because while there are significant savings buffers accumulated from the pandemic. So I think the stock of household savings was about 3 trillion USD. And while the labor market remains at historic, unemployment remains at historic lows, ultimately, as we saw from the inflation print on Friday, that the headline inflation reached another peak, I guess. Not another peak, but rather it actually accelerated further from the previous month. Is that, I guess, one takeaway from that is that inflation is not going to come down so easily. In order to get inflation down to the Fed's target range of, say, 2 to 3%, it will require a significant pace of rate hikes. And in order it's difficult to actually ramp up such a significant pace of rate hikes without dampening US growth. But currently, right now, as a baseline, as I said, we are still expecting positive growth for 2022 and 2023. Expectation of oil price, should that happen, I think largely it depends. There are a lot of things going on for oil prices. So since there are so many variables, it's difficult to estimate what exactly will be the oil price if that happens. Just to, for instance, if the US go to hypothetically go into a recession and it would actually depend on whether China, which does not actually follow the economic cycle of the US, how is it doing? Is it recovering? Which would boost demand for oil, and also in terms of whether how OPEC responds in that kind of situation. So I think I'll let Hui answer the question on gas. Yeah.
Yeah, hello. Let me put some color on the name, the gas. Regarding the question if recessions happen, so it's got to set charts. So basically, just a brief about gas is the monopoly of the gas distributor of Vietnam. So they distribute the natural gas for the whole economy. For this part, if we see, we're looking at Vietnam as a growing economy with GDP growth average over the past few years of about 5 to 6 to 7% normally, and even in this case of some more, we still have GDP growth of like 3 to 4% growth. So you see that the demand of the electricity consumption in Vietnam is going to be quite solid. So in that sense, we're going to be quite sure that the demand for dry gas is going to enjoy quite solid growth for the next for the long term horizon. So in that sense, on the volume of the demand side is secure, and on the pricing of the gas. So gas in Vietnam, they have a special mechanism to protect their profit. Is that they will sell the dry gas above their buying cost. So in that sense, even when oil price down to $30 or even $0 a gas can still enjoy about 6 to 7 trillion dong per year. So it means that we have a downside protection for gas, and at the oil price assumption of $100 per barrel for this year, so we're going to see like 50 or 60% growth in earnings, and the PEs is around 15. And in the case that oil price collapse to below $50, we're going to see that the earnings going down, but the PE is going to be stay about 25 times in the worst case for the gas. So you see that in normal times when gas was trading at around 20 times PE. So I see that the downside is around 25%. In the worst case, that the whole demand of the global collapse and oil price stayed at below $50 per barrel. So I think for that downside, I think gas is still a safe choice right now.
That assumption is unrealistic, right?
Yeah, that's assumption is unrealistic.
Now the average oil price we expect is $100 per barrel.
Yeah,
and even now Global House estimate it can go up to $150 in the next 3 to 6 months.
Yeah, in that case, happen you're going to see that the PE of the company will go down to 12 times.
Thanks to like 80 or 100%.
Yeah, 100% earnings growth.
We have a question on the property market and bond market, right?
Explain the deal.
Okay, we go first with that one.
Okay, about the legal turmoil. Actually, there are two separate turmoils in the market. First one is related to the listed stock market. The second one is related to corporate bond market. And these two turmoils coincidentally occur at the same time and hit the margin activities in the stock market. Just to recall that the excess speculation using a lot of margin lending in the stock market fuel the rally of the market last year, focused on small and mid caps, and that's why when these two turmoil occur, we see a significant contraction outstanding margin and cause a liquidity crunch in the market in the past 2 months, and that's why the market tumble around 40%, as I have presented, and it's
I think let me pick up quickly. So because the question from was it Chin Hong is a bit new to the market, so let's think it very simply. So in Vietnam, the stock market and bond markets are young, and it has been growing so fast in the past 3 years. Especially we see the liquidity in the stock market jump from the $200 million per day like to $1.5 billion. So from the regulators' perspective, they think it's a bit heated and they want to control it. So when they do the investigation, do the review, they file out some fraudulent in terms of like how do they trade the stocks, and also how they issue the bonds, how they use the money from the bonds. So that's why they carry out a review and investigation from the beginning of April. And from that time, we see the market correct, and it due to the concerns that the investigation would spread and there would be more detention of the high-profile people, and that affect the sentiment. On the real thing is the liquidity, yet the liquidity was affected as well. We see the liquidity drop back to around $600 to $700 million per day. So the question is going forward is what would happen to the market? So from the stock market, we think that the cleaning up like that is necessary, and it helps the market become healthier, and it is necessary for us to continue our attempt to upgrade the market to emerging status. That's the first thing. The liquidity, I think after that investigation, the market liquidity drop, and we see the margin lending book also, drop from the peak of like $10, $11 billion to around just
second rate.
It dropped about 35%. And we talked to the brokers, we talked to the broker house, and we see that the margin room now is open, but the retail, they are not using that. So from my perspective, in terms of money to support the market going up is okay. We do not agree or worry about that. But for the bond markets, yeah, that's something we should care about now. Because now the views on how to recalculate, how to operate this market is still under discussion with the new regulatory framework. The discussion is still going on, and we know that because the market stakeholders are contributing a lot of inputs so that the regulator fix the regulation in more balance. Because according to the latest version that we know is a bit tightened, and it would create a lot of pressure and difficult for the companies in Vietnam to raise new bonds and to refinance. And because the view of the regulator now is that they just want to tighten the issuance conditions, and many of them are quite rigid in my view, because there's one thing very simple is that they want to tighten the purpose of the issuance, like what money you are going to use for, and that would be a bit too tight. So in a good case that we expect now is that the final version of the regulation is in balance, and it still allow companies to issue bonds more normal. It just they just need to be transparent. Then companies continue to issue bond and refinance the bonds that are going to be due like in the next 6 months. We estimated about how much about $6 or $7 billion, right? And the next year is about $10 to $11 billion each year. So now is a critical time for us to watch at the bond market in terms of regulation. If the regulation is balanced, that's what we are expecting now, then we could see nothing. I mean the market would come back to normal and could continue to grow. But if the regulation a bit tightened, then we would see the bond issuance would be a bit.
Sorry, I think their internet froze. Sorry about that. Let me try and
It's something we need to watch. Yeah.
Okay, they're back. Okay, great. Thank you. Tan, I think we actually missed out on what you said for the last 10 seconds or so, because your screen and audio froze.
From where? Sorry.
The last, say, 10 seconds or so.
Okay, so I mean like, okay, so let me sum the view is that the bond markets have been growing fast, but the bond value over GDP in Vietnam is only 15% now compared to Malaysia or Thailand market, which just half or a third of that. So it still have a lot of room to grow. It's just the view now, the view from the regulator, because they see a bit heated, so they want it to slow down, clean up, and prepare for the next cycle of growth. It's just how they are going to regulate it. So it depends on the new regulation. And from our perspective, we expect that the final version of the regulation would be more balanced. It allows the companies to continue to issue bonds, to raise money, even refinancing. That is something that is very normal. I don't expect that is a risk, and I hope the regulators would buy in these views. So if that's the case, we believe that everything would get back to normal in the next. I expect the regulation would come by the end of the year, so everything would come back to normal. But if that is not the case, then we should see some problem with the refinancing, and there's a risk of corporate bond default. So overall, to me, GDP growth is not a problem for now. Inflation is still okay. It's just a bond. To me, is a key risk to watch for Vietnam now.
Thank you. Our next question in the chat box regarding the investigation. When do you think this issue would be really ending and cause improving market sentiment? About VHM, do you expect any impact from the corporate bond market issue?
For the corporate, for the investigation, I think it's already done. I think we can, you can say that we would not expect to see anything like the detention of high-profile CEO like Tân Hoàng Minh. I think it's done, and I also understand that the investigation around Tân Hoàng Minh would only, scale down to its bond issuance, would not be any further spread to affect the market. I think that the regulator, they see the systematic risk already, and they will not act recklessly as before. For the impact of corporate bond on Vinhome, I think I would let my property analyst to answer it to be more comprehensive. But to me, because Vinhome, the financial ratio is very strong, and they have no problem. They even can raise money from offshore bond issuance. Is that okay?
Yeah. Yeah.
Do you want to add anything to?
Yeah, sure. I think there's another questions, right, on the view of real estate and corporate bonds market that maybe we missed out on top of the chat box as well. So maybe I'll group it into one and answer you in the same time now. So to us, right, actually we wrote a detailed report, right? So if you want to revisit that report, you certainly can. But for answering the question, maybe I'll share back the screen here for everyone to see. If you've seen my screen yet. Give a sec so that it can okay. So this is a report that we wrote during the corrections and during the investigation of the corporate bonds and also of the real estate market in Vietnam. So there are three things, right? To sum up, there are three things that we can see. Number one is the government scrutiny of the capital market, right, in general, in bond market, in equity market, and also on tightening on the bank loans. The second thing is that the market overly factored in the risks of the corporate bonds.
And lastly, what is the view of the real estate sector? So on the valuation angles, right, we think that is already being very attractive since it is becoming one of the hardest hit so far in the market. So I'll talk. So to answer your questions very quickly, right, we are still very bullish on the real estate sector. On all the fundamentals still remains the same. So you still have a low penetration, you still have a highest absorption rate in ASEAN as well as in Asia. And we are also still enjoying a very high gross profit margin compared to countries like China, Malaysia, so therefore, I think right now, property developers in Vietnam are still going to have a long way to go in terms of growing, and we're still at a very nascent upcycle in development of this real estate market. So the main thing that is happening right now, I think, right, we think is the some turbulence that has to happen, right? Obviously, we do not have a legal framework for real estate as well as many other sectors. So completing a legal framework, regulation framework is something that Vietnam has to do. So this happening of this, investigation, ongoing investigation, and drawing new legal framework is something that the government had to do, and their views, right? So we share a bit on their view. So right now they wanted to promote integrity and sustainability, like Anh Thanh and we said, right? They wanted to upgrade Vietnam into investment grade. And in order for us to do that, the number one thing to do is to establish a legal framework. And that is what they are doing, try to promote integrity and sustainability rather than try to crack down and stop this equity market, bond market, and capital market to grow. That is number one. On the corporate bonds, right? What is the view? We think that has been quite hot in the past 2 years. If the worry is actually real, if you were to look at this chart, right, the total bond issuance value in Vietnam has been increased by a CAGR of 5 years of about 55.4%, which is a lot. But if you were to look at the peers, right now we are doing about 14%. The total bond issuance of Vietnam compared to GDP. If you were to compare to other countries, let's say Thailand is more than 20%, Malaysia is even more than 50%, Malaysia 50%, Singapore is also about 30%. So therefore, we are not yet at the stage that is already heated. So I think, right, with the lower penetration of the bond issuance in Vietnam, I think that there will still be room for it to grow. Recently, we organized a talk with the regulator in Vietnam. What they have already addressed publicly, right, is that, I just quote back from the regulator, that they are aiming to double up the growth of the bond issuance value in Vietnam in the next 5 years or so. That is one of their KPI. So their KPI is to grow the bond market in Vietnam and not to destroy or hold back their growth. They just want to establish a good legal framework so that when new bonds are issued, investors are protected, and they are protected under a better legal framework. So that is our view on the real estate sector as well as on the bond sector. And when it comes to real estate, right, there's another chart that I want to share with you all, which is this chart. So to sum up, right, after the correction, so this is slightly dated a bit back into May, but most of the stock has not yet gone up significantly. So they're still trading around this range, right? After the correction, right, you are seeing that we are doing way below the average trading values of most of the players in the market right now. And if you were to look at the FY22 PAT growth that is guided by the management, right, we're still, except for Vinhomes, right, which is on a separate case that I'm gonna talk in a minute, but everyone else are expecting a growth, if not very strong growth in their net profit. Why is that? Obviously, fundamental stays the same. We're still at a very nascent upcycle of the growth in the market. Therefore, we are still looking at a very good earnings year coming for most of the property developers in Vietnam. If you were to look at Vinhomes on a separate case, right, on the questions that is the bond market right now is going to impact them, I would say there would be some impact in terms of the domestic raise bond. So it would be like, it would take a slightly longer time for them to get approvals and so on, but that is it. Right. If you were to look at the gearing, right, Vinhome is actually one of the lowest in terms of gearing. So they do not borrow that much. Why? Because they can sell very good. So therefore, they have a lot of short-term cash coming into them to use as the short-term capital for them to develop their market. The reason why their PAT growth is lower is because they are in the transition phase of moving from the three finished mega projects that they already sold almost done to a new 3 mega projects at a bigger scale, and that would take some time for them to actually do pre-sales and get the profits coming in the next 1 to 2 years. So that is the reason why Vinhome's PAT growth may seem low. However, with this minus in terms of growth, right, they're still doing it more than 1.5 billion in net profit this year, which is also helping them to trade at a significant lower, less than 10 times PE right now. So I think Vinhome's case is not really worried on that sense of obviously on the bond issue and also on the PAT growth. That would be what we.
Thank you. Next question from the chat box, also from Ingguan. Between residential real estate and industrial estate, which one do you believe will have better outlook and valuation in the next few years?
Residential real estate
and industrial estate, which one do you believe have better
in the next
outlook and
few years?
valuation?
Let em muốn trả lời.
Em trả lời.
Em trả lời.
Okay. Let me address this question with a slide so it's easier. So out of the two, right, I think they're all at a nascent growth stage. And to measure which one is having more growth, I think it's a bit difficult because they're all growing very fast, right? But which one is more investable? I think I would say residentials. Number one is that we have more choices. You have more capital market cap. So the stock market capitalization is a lot bigger in the residential side compared to in the industrial property side. So therefore, if you are a long, long investor, long only, or you hold longer, right, with a long horizon view, I think, and if you want to hold, mid to big cap, I think residential is the space that actually you have more choices to invest compared to, industrial real estate. Industrial real estate, there are big cap stock as well, of which I can share with you the slide, but most of them are actually quite uninvestable because the float is quite small and the access to information from the management itself is not as clear as compared to residential areas. Therefore, if I were to suggest a space that you can invest, right, and hold, I think residential lies more opportunities for you. But if you are okay to trade, I think there's a lot of opportunities that industrial estate can bring to you because the share price can be fluctuate at times, right? And if you follow the market closely enough, you actually can trade on it because it's a retailer's favorite on the industrial estate. So there's a lot of stocks that is having good fundamental at the same time, having a lot of volatility of which you can actually trade on it. But obviously, two downside. Number one is the market cap is smaller. Number two is that the float is also smaller. So maybe the liquidity is not something that you prefer, but depends on the type of fund that you are holding.
Yes. I think the industrial part, the size smaller, but it's more volatile.
Yeah.
And then they already, run ahead of the residential. So valuation is not as attractive as the residential property. Because the next 1-2 years, the industrial parks will enjoy the good story in terms of more FDI coming to the country. The average rental rate is still rising and still at high. And the retail, they love it because it's easy story to understand, and they feel that the industrial part is not exposed to the regulatory headwinds at the residential properties. But if I have to take now from the valuation perspective, from the side, the liquidity and the volatility, I think residential property is better choice for the buy and hold position now.
Yeah, maybe to finish off, I'll share with you a bit on the screen here. So I've done this quite some time ago. So there's a slide on industrial parks, right? So roughly we're still quite good in terms of FDI. We're still doing well in terms of the price of the land bank, right? That we are having in the industrial parks here. Vietnam is actually very free in terms of trade. So we are number one in terms of highest FTA. We have the highest FTAs compared to peers in the region. If you were to look at figure 23 here, so Vietnam is actually having most with FTA with most of the region in the world, right, except for the US, and we are actually negotiating one with them right now. But the liquidity is the issue, like I mentioned. So you have the market cap here. The biggest probably is BKMX and GVR, right, which is all right, right, in terms of size. But if you were to look at the floating stake, it's actually quite small, 3%. The most investable one probably is KBC here. You know, market size is quite okay, about 300. Floating stake is about 60%, 70% of floating stake. However, again, KBC, the share price can be quite volatile, and this kind of market cap is not for everyone. Yeah. All right.
Okay, thank you very much. Are there any further questions from the floor? Any further questions? If there are no further questions, then Tan and team, do you have any closing before we end the session?
Well, yeah, we would like to thank you very much for spending time with us. So our Invest ASEAN event has started last week with a regional discussion on hot debate. So this week we start our corporate week, and we start with the Vietnam. And after our market strategy presentation today from this afternoon, we are going to start with the meeting directly with the companies, and we bring to this year about 21 leading companies in the logistics, retail, banking, property, exports. So we hope that you would find useful and informative. There's many interesting names, and for banks, I hope that you would enjoy more content in digital banking, in ESG adoption. That's something we would like to bring the value to you, because we know that during this time, you have many other corporate events to join too. But we hope that you would come to us and find some valuable information for your investment strategy. Thank you very much. Have a nice day.
All right, thank you very much to the Vietnam research team and also to Brian for the presentation today. And thank you everyone else for having joined us. Our next session is with Masan Group, and it will be at 1 p.m. Vietnam time or 2 p.m. Singapore time. We hope to see you there. Thank you very much.
Thank you. Yeah.
Thank you.